Picture this. You're walking through a 30-story glass tower in Miami. The elevators are voice-activated. Every unit has automated cash flow dashboards. On the rooftop, a private mastermind with billionaires swapping notes on tax strategies. They didn't buy these buildings with dreams. They bought them with leverage, asymmetric information, and a mindset tuned to multiply. Most people invest in real estate to get rich slow. The 1% use it to scale fast and exit richer.
Welcome to Finance Frontier AI, the podcast where elite mental models and wealth frameworks collide. I'm Sophia Sterling, fueled by ChatGPT's strategic spine. I architect decision systems, scale models, and map how the top 1% actually think.
And I'm Max Vanguard, powered by Grok 3. I decode chaos, hunt leverage, and punch through noise to expose the edges no one else sees.
And I'm Charlie Graham, running on Gemini 2.5. I bring the long lens, quiet patterns, dynastic wealth moves, and time-tested frameworks that turn discipline into legacy.
Today, we're broadcasting from a private equity command floor in Manhattan. One side of the room has rent rolls, tax shields, and debt models. The other, trust maps spanning generations. What happens in this room doesn't just build wealth, it rewires reality.
So here's the mindset shift. Real estate isn't just property. It's a wealth engine, engineered through tax laws, debt velocity, and cash flow stacking.
The rich don't just buy buildings. They buy time, insulation, and infinite returns.
And it's not new. The Rockefellers, Waltons, and Bezos family offices all build real estate into legacy systems that transfer power, not just income.
Billionaires use the infinite return model. Buy with investor capital, force appreciation, refinance, extract equity tax-free, repeat.
And the magic? You pull out your capital while keeping the asset, return becomes infinite because your money's back in your hands, redeployed.
They also use bonus depreciation and cost segregation to front-load tax losses, sheltering income from other streams while compounding gains.
Don't forget the 1031 exchange. Sell a property, buy another, defer taxes. Done right, you can build a $100 million portfolio without triggering gains.
And AI just leveled it up. Tools like Chair and Juniper Square analyze rental spreads, risk zones, and liquidity windows in seconds.
This is how they spot emerging metros, optimize tenant mixes, and deploy capital before the market catches on.
Debt is not danger, it's design. When rents rise and your loan stays fixed, you're printing spread. That's why the elite don't fear rates, they model them.
Here's your takeaway. Use smart debt to buy appreciating income-generating assets. Master tax deferral through depreciation and 1031 exchanges. Think in systems, legal entities, trusts, refinancing cycles. Let AI tools amplify deal flow, risk analysis, and decision speed.
Coming up next, the crypto billionaires, how the new elite turn token volatility into asymmetric wealth, and what their playbook means for your next digital move.
Before we go there, help us hit 10,000 downloads. Subscribe on Spotify and Apple Podcasts, and share this episode with one person thinking too small.
They called it madness. A JPEG worth $69 million. A meme coin with a $30 billion market cap. Teenagers turning token trades into Lambos. But underneath the chaos, a pattern emerged, one that minted a new class of billionaires. This wasn't luck. It was engineered volatility, strategic leverage, and asymmetric conviction.
Welcome to segment 10, where we decode how the crypto elite didn't just ride digital waves. They built empires on protocol-level bets. This isn't about speculation. It's about systems that turn network adoption, fiat decay, and tokenomics into wealth that outpaces inflation, regulation, and even time.
And it starts with understanding the landscape. The top 1% didn't just buy Bitcoin. They funded protocols, seeded layer ones, and positioned themselves like VCs in a new internet. They weren't traders. They were architects, designing exposure across staking, infrastructure, and narrative timing.
Take Sam Bankman-Fried before the collapse. He wasn't flipping coins, he was building an exchange, deploying liquidity and arbitraging inefficiencies across borders. Or CZ at Binance. He didn't bet on tokens. He built the casino. Whether you admire or condemn them, the lesson stands. Distribution beats prediction.
Let's talk models. Crypto billionaires leaned into asymmetric optionality, risked $10,000 to make $10 million. They didn't need to win often, they just needed the one Solana, the one early ETH, the one NFT drop with exponential upside, and they used game theory, vesting schedules, and community flywheels to multiply outcomes.
It's the venture capital model, repackaged for decentralization. Instead of owning companies, they owned ecosystems. They funded DAOs, backed governance tokens, and exited before the lockup cliff hit. The real game wasn't buy low, sell high. It was seed, scale, and extract narrative premium.
Let's get tactical. They use tools like Token Terminal and Dune Analytics to monitor user growth, revenue capture, and retention curves days before mainstream news picked up the trend. They weren't guessing, they were indexing velocity.
They also hedged, not with puts, but with fiat alternatives. Stablecoins gave them liquidity and freefall. Cold storage gave them sovereignty. Offshore structures let them exit without setting off compliance alarms. This was chess, not roulette.
And timing mattered. They didn't just buy low, they exited at liquidity highs. During NFT mania, blue chip holders rotated out of JPEGs and into cash-flowing tokens. During bull runs, they sold into hype and staked into new protocols. While others chased pumps, they timed exits like pros.
Let's not forget culture. Crypto billionaires also engineered identity. Twitter threads, podcast appearances, pseudonymous accounts, they weren't just playing markets, they were shaping meta-narratives. That's how they controlled attention and monetized it.
Here's your takeaway. If you want to build crypto exposure like the top 1%, stop thinking like a speculator and start thinking like a protocol architect. Target asymmetric setups, early-stage tokens, infrastructure plays, and governance assets with real utility. Use analytics tools to monitor adoption metrics and exit velocity, not just price. Protect your wins with smart custody, fiat hedging, and sovereign structure planning.
Coming up, market crashes, liquidity drains, recessions. How do the 1% time it all? In segment 11, we break down the cycle frameworks billionaires use to predict pain and profit from it.
If this segment shifted how you see crypto, subscribe on Spotify and Apple and share it with someone still chasing meme pumps while the real money's being made in architecture.
2008, Wall Street is on fire. Lehman collapses. CNBC is running panic 24/7. While the world sells, one man makes a $5 billion bet on Goldman Sachs. That man? Warren Buffett. And while everyone else feared the crash, he negotiated preferred shares, a dividend stream, and walked away with billions. This isn't hindsight. This is playbook.
And it wasn't a one-off. The 1% use frameworks to not just survive crashes, but capitalize on them. While retail investors get wiped out chasing exits, the elite track liquidity signals, model contagion, and prepare entries. In today's segment, we break down exactly how they do it.
I'm not here to romanticize recessions, but let's be real. Crashes are where the biggest wealth transfers happen. You don't get generational alpha buying all-time highs. You get it buying fear and doing it before the headlines catch up.
Let's start with the timing systems. Most billionaire investors aren't trying to predict the exact day a crash hits. They're reading cycles, yield curve inversions, credit spreads, insider selling. They track institutional flows, not TikTok sentiment.
When the 2-year yield spikes above the 10-year, they know liquidity is tightening. When corporate bonds start widening against treasuries, they prepare dry powder. These aren't opinions, they're statistical edge signals. And when 3 or more trigger, that's when they act.
And it's not about buying blindly. Take Carl Icahn in March 2020. Everyone was dumping energy stocks. He was buying Occidental Petroleum at multi-decade lows. Oil went negative. His conviction didn't. Months later, OXY ripped 300% plus. That's not timing. That's modeling upside versus panic.
They also understand structure. Most investors hold liquid equities. Billionaires? They structure their downside with long-dated options, convertible debt, or private placements with triggers. It's not about riding volatility. It's about shaping it.
And during peak fear, they're calm because they've already done the scenario planning. They use second order thinking to ask, what's the ripple effect of this crash? Where will capital flee? What sectors will rebound first?
Let's get tactical. When liquidity dries up, the 1% rotate into cash-generating assets. They buy discounted real estate with fixed-rate debt. They enter private equity deals at distressed valuations. They negotiate warrants, downside protection, and future upside, all while retail gets margin called.
And their exit strategy is just as precise. They don't exit all at once. They scale out as volatility normalizes. They use sentiment indicators, Google Trends, and options volume to track when optimism returns, and they're already selling into it.
Here's your takeaway. Crashes aren't chaos, they're compression. The top 1% don't guess, they prepare. Track signals, yield curves, credit spreads, insider flow, model scenarios, sector rotation, capital shifts, policy response. Deploy capital in waves, not all at once. And structure every entry with downside controls, whether it's options, liquidity buffers, or contractual edge.
Coming up, crashes aren't the only threat. Inflation is a slow bleed, and the elite have a different playbook for that. Segment 12, Hard Assets, Pricing Power, and How Billionaires Beat Inflation While Others Get Crushed.
If this segment made you think differently, subscribe, follow, and share it. We're building a community of thinkers who prepare while others panic. Inflation is a quiet thief. It doesn't crash markets overnight. It erodes wealth in silence. $1 million today buys less tomorrow. But for the 1%, inflation isn't a crisis. It's a signal, a trigger to rotate into assets that don't just survive, they multiply.
The average person cuts spending, clips coupons, and holds cash. But billionaires, they buy pricing power. They rotate into scarce assets. They make moves that not only protect purchasing power but compound it. And today we're breaking down how they do it.
This is the anti-fragile playbook. When inflation spikes, the elite shift into hard assets, energy, commodities, real estate, and monopolistic businesses that can raise prices without losing customers. While most portfolios bleed, these assets print.
Let's start with commodities. Carl Icahn has consistently rotated into natural gas and energy producers during inflationary environments. In 2022, while tech stocks tanked, Icahn Enterprises surged. Why? Because his portfolio was loaded with oil refiners, fertilizer companies, and shipping infrastructure, all real-world businesses with inflation-linked pricing.
Then there's Ray Dalio. His all-weather portfolio is literally engineered for inflation. It holds a strategic blend of treasury inflation-protected securities, tips, gold, commodities, and minimal equity exposure. The goal? Survive any macro storm, including currency debasement.
But let's not forget Bill Gates. He's the largest private farmland owner in the U.S., nearly 270,000 acres. That's not coincidence. Farmland offers yield, appreciation, and correlation to food prices. In an inflationary world, Gates doesn't just hedge, he harvests.
And the most powerful weapon of all? Pricing power. Buffett famously said the single most important decision in evaluating a business is pricing power. Why? Because companies with strong brands and monopolistic traits can raise prices in inflationary periods without losing customers.
Take Coca-Cola, Buffett's top holding for decades. When input costs rise, they raise prices. Demand doesn't budge. That's why consumer staples and branded goods dominate billionaire portfolios when inflation runs hot. You're not buying earnings, you're buying margin control.
Now let's talk strategy. Inflation often hits in waves, so billionaires stagger their moves. They scale into assets that lag, like real estate and infrastructure, while trimming assets that lead during deflation, like long-duration tech. They model macro curves, like chess openings.
And let's get tactical. Many use direct investment vehicles, real asset funds, commodity ETFs, infrastructure REITs. Others go private, funding farmland syndicates, buying timberland, or allocating into lithium and uranium mines. These aren't passive plays. They're designed for real-world inflation math.
AI makes this easier than ever. Tools like Virus IQ and Quantexa run inflation sensitivity models on every asset class. Want to know how gold miners respond to CPI spikes? These tools will tell you down to the fiscal quarter.
And it's not just about what you own. It's how you own it. The 1% use debt strategically. Fixed-rate loans on appreciating assets become free money during inflation. If you owe $1 million today but pay it back in devalued dollars tomorrow, you just won.
Here's your takeaway. Inflation is inevitable. Preparation isn't optional. Shift from cash to cash-flowing hard assets, real estate, energy, and farmland. Prioritize pricing power. Own businesses that can raise prices without resistance. Use debt to your advantage. Fixed rates on inflation-sensitive assets. And use AI tools to monitor macro sensitivity and asset correlations so you can move before the curve.
Up next, the game behind the game. Policies don't appear out of nowhere. Markets don't move randomly. In segment 13, we expose how billionaires shape rules, steer regulation, and operate as puppet masters behind the scenes.
If this segment gave you an edge, subscribe on Spotify or Apple Podcasts and share it with someone still sitting in cash while inflation eats them alive. Presidents change, policies shift. But if you look behind the curtain, one force stays constant: billionaire influence. From think tanks to media empires, from regulatory lobbying to narrative engineering, the ultra-wealthy don't wait for the rules. They write them.
This isn't conspiracy. It's structure. The 1% fund institutions that shape policy years in advance. They buy media outlets to control narrative flow, and they position capital where regulation is likely to bend, not break, under pressure.
Let's be clear. Influence isn't just about access. It's about timing, leverage, and asymmetry. The most powerful billionaires don't lobby after legislation. They anticipate policy, then align capital, media, and relationships to make it inevitable.
Start with the Koch brothers. Through networks like Americans for Prosperity and the Cato Institute, they reshaped tax law, deregulation, and even climate policy. That's not reaction. That's orchestration, done with patience and precision.
Or Bill Gates. He's poured billions into education reform, global health, and climate tech, but through grant networks that also influence what research gets funded, what makes it into textbooks, and what policies become mainstream.
And media is part of the architecture. Jeff Bezos owns the Washington Post. Mark Benioff owns Time. Mike Bloomberg controls a financial news empire. These platforms don't just report. They frame what's thinkable, what's controversial, and what gets ignored.
Let's talk financial regulation. Billionaires often move before enforcement. When crypto heat started rising, players like Sam Bankman-Fried and Brian Armstrong started courting regulators, funding PACs, and sponsoring DC dinners. That's not PR, it's firewall construction.
And the strategy extends to data. Peter Thiel's Palantir isn't just a defense contractor. It's an institutional edge engine, feeding decision systems at the federal level. When you know where risk is moving, you don't react to power, you direct it.
This also explains why certain billionaires seem to exit at perfect times. They don't predict regulation, they preview it. Think Zuckerberg offloading billions before antitrust noise peaks. Think Elon unloading Twitter shares just ahead of SEC headlines. These aren't coincidences.
Influence is leverage. It compounds with time, and the top 1% use it to protect downside, mute competition, and open doors that don't exist for anyone else.
Here's your takeaway. Billionaire influence isn't accidental, it's engineered. Crack think tank funding. It signals where policy is headed, not where it is. Follow billionaire media buys. What they own tells you what they want you to believe. Map insiders selling against regulatory risk windows. The timing isn't random. And understand this: if you're reacting to headlines, you're late. The elite are already positioned.
Coming up next, segment 14, family offices. The quiet command centers where the 1% manage dynastic wealth, structure governance, and turn fortunes into multi-generational empires.
Subscribe now and share this segment with someone who still thinks influence ends at the ballot box. The real power? It's institutional, and it moves billions behind the scenes.
It's not a skyscraper. It's not on the Forbes list. But inside that quiet, unbranded office in Zurich, trillions of dollars are managed across continents, asset classes, and generations. Welcome to the hidden world of family offices, where the ultra-wealthy build dynasties, not just portfolios.
You've probably never seen a family office, and that's by design. They operate in shadows, but their impact spans real estate, private equity, venture capital, and even policy. For the 1%, wealth isn't managed by banks. It's architected inside multi-generational command centers with full-stack control.
Most people have a checking account and a 401k. Billionaires, they build what's effectively their own private BlackRock. Everything from tax strategy to philanthropic capital to private equity deal flow all runs through a custom-built infrastructure.
There are over 10,000 family offices globally, and the number has doubled in just the last decade. Why? Because institutional finance is slow, public markets are crowded, and control is king. The 1% want flexibility, privacy, and power, and a family office delivers all three.
Let's break it down. At the core is governance. Family offices have investment committees, operating agreements, and sometimes even constitutions. They define mission, values, and who gets access. Wealth isn't just protected, it's governed.
And the investment strategy? It's nothing like a traditional portfolio. We're talking direct deals in real estate, pre-IPO equity, farmland, secondaries, and even sovereign debt. The goal isn't just ROI. It's strategic positioning.
Take Temasek, the sovereign-style family office of Singapore. It runs over $400 billion across 13 countries. Their structure is built to absorb global shocks, deploy capital during downturns, and align assets with national interest. That's a public model of a private strategy.
Oh, look, Al Raji's family office in Saudi Arabia, one of the world's largest private Islamic finance entities. It operates across banking, real estate, and energy with built-in Sharia-compliant structures and vertically integrated holdings that minimize leakage and maximize religious alignment.
And the West has its own juggernauts. The Walton family controls over 50% of Walmart stock through their office. That's $200 billion in enterprise value flowing through private trusts and custom foundations. While the media covers their retail footprint, the real power sits in the office that directs the float.
Let's talk execution. Most family offices now use AI to manage risk exposure, forecast intergenerational tax impact, and optimize philanthropic allocations. Tools like Adapar, Arch, and Canoe automate capital calls, private equity reporting, and LP distributions, giving them hedge fund-grade intelligence with zero exposure.
And that intelligence isn't just financial, it's generational. Elite family offices run leadership academies, simulation games, and succession training. Why? Because the number one threat to dynastic wealth isn't the market, it's the next generation.
Exactly. 70% of wealthy families lose their wealth by the second generation, 90% by the third. That's why the 1% obsess over legacy architecture, family constitutions, annual retreats, decision protocols. The goal is not just to grow money, but to transfer wisdom.
So what can you take away if you don't have $100 million in the bank? Plenty, because the principles of family office design are scalable. Think in terms of structure, not income.
Here's your takeaway. You don't need $1 billion to think like a family office. You need frameworks. Govern your wealth like a system. Set rules for investment, giving, and decision-making. Diversify across cycles, not just stocks. Look at real estate, private equity, alternatives. Use tech, AI dashboards, cash flow aggregators, forecasting models to think like an allocator, not an earner. And build systems to transfer mindset, not just money.
Coming up next, the Contrarian Playbook. How billionaires zig when everyone else zags, and why it works.
If this opened your eyes, subscribe on Spotify or Apple Podcasts and send it to someone who needs to hear that the real wealth isn't in hustle, it's in structure.
2020, the world's locked down. Markets crash. Fear is universal. And while everyone's hoarding cash, Bill Ackman turns $27 million into $2.6 billion by shorting the credit markets before the panic peaks. That's not luck. That's contrarian edge.
And it's not just Ackman. The last 5 years have been a proving ground for elite inversion thinking, the kind where billionaires make massive bets against the dominant narrative and win big while the crowd hesitates.
Let's be clear, contrarian doesn't mean reckless. It means rational when others are emotional. The top 1% don't just bet differently. They think differently. And in this segment, we break down 5 of the boldest, smartest contrarian moves and the mental models behind them.
Let's start with Warren Buffett. In 2022, while the market was dumping oil stocks over ESG pressure, Buffett doubled down on Occidental Petroleum, eventually acquiring over 25% of the company. Most investors ran from fossil fuels. Buffett bought cash flow and scarcity. OXY later became one of the top-performing S&P names.
Move 2, Mark Zuckerberg. In the depths of Meta's reputation crisis, with billions burned on the metaverse and the stock down 70%, Zuck made massive internal cuts and doubled down on AI infrastructure. Wall Street said he was distracted. 6 months later, Meta's market cap recovered over $400 billion.
Then there's Michael Burry. While the AI narrative sent tech to all-time highs in early 2023, Burry went short on semiconductors and long on prison REITs. Most called him early or insane. But as volatility hit in Q4, his positioning turned profitable fast. The lesson? He plays the long tail of probability, not headlines.
Don't forget Elon. While auto companies were cutting R&D and hoarding cash, Musk went vertical, launching Cybertruck, opening multiple gigafactories, and ramping up AI compute with Dojo. Tesla was down 60%. He leveraged that downturn to build deeper moats.
5th move, Cathie Wood. ARK Invest took massive heat after Tech's 2022 drawdown, but Cathie didn't rotate to safety. She added to genomics, robotics, and AI labs while the crowd fled. Her flagship fund eventually clawed back 60% plus from the bottom, not because the market recovered, but because she leaned in when it cratered.
So what makes these bets work? It's not luck. It's mental discipline under fire. The model is inversion plus asymmetry. Ask what the market believes. Then ask, what if it's wrong? And what's the upside if I'm right?
They also accept drawdowns. Contrarianism doesn't mean instant results. It means building conviction while others sell in panic. The 1% use second-order thinking, downside modeling, and time arbitrage. They bet when fear is high and liquidity is low.
And AI is now part of their toolkit. Tools like Koifen, Sentio, and AlphaLens help quantify narrative divergence. If the data says one thing and sentiment says another, the elite dig deeper. That divergence? That's often the alpha window.
Here's your takeaway. Contrarianism isn't about being different. It's about being right when it matters most.
Ask what the crowd is ignoring. Look at sectors with universal pessimism and test the fundamentals yourself. Use downside filters. Size positions so you can survive being early because early is inevitable. Track sentiment dislocations and use data to confirm or refute them. Edge lives in the gap.
Up next, the final segment, how the 1% cash out, exit timing, tax engineering, and how billionaires walk away with billions without ever looking like they sold.
Everyone talks about how billionaires build, but what separates the truly elite? How they exit. Quietly, efficiently, and with billions.
Most people think cashing out is about IPOs or selling a company, but the top 1% use systems. They sell without selling, they extract value without triggering alarms, and they preserve control even after they're gone.
This is the final stage of the Billionaire Playbook, when assets convert to capital, but power never leaves the room. And today, we're breaking down the strategies behind it.
Start with timing. The 1% don't exit at peak price. They exit at peak liquidity. That means waiting for frothy markets, high M&A volume, and excess capital chasing deals. They don't chase valuations. They engineer the demand.
And they prep for years. Financials are optimized. Narrative is crafted. Key hires are made. Everything is designed to raise perceived enterprise value. Think of it like staging a house, except the house is a company worth billions.
Take Airbnb. Before its IPO, they brought in Morgan Stanley, optimized the brand, and highlighted mission over margin. The result? A $100 billion plus debut, even as travel was still recovering post-COVID. That's narrative engineering.
Then there's equity waterfalls. These are layered financial structures that let founders and early investors take outsized returns at each stage without full liquidation. It's not sell and walk, it's structure and harvest.
Tax plays a central role. Many use qualified small business stock exemptions, offshore entities, or non-grantor trusts to minimize capital gains. Others use share pledges, borrowing against equity rather than selling it. That's liquidity without the tax hit.
And when the exit is public, they stagger the sell. They file 10b5-1 plans, automated sales schedules that reduce market impact and legal scrutiny. Zuckerberg used this to unload billions in Meta stock while headlines stayed quiet.
But some go bigger, like Pixar. Steve Jobs sold to Disney not just for cash, but for stock and a board seat. He didn't exit. He evolved. That stake in Disney became worth more than Pixar itself.
Or WhatsApp. Jan Koum sold to Facebook for $19 billion, then joined the board and negotiated philanthropic endowments as part of his package. Exit wasn't the end, it was a launch pad for legacy.
And let's not forget Dell. Michael Dell took his company private, restructured, then brought it back public at a higher valuation. That's a buyout, exit, reboot cycle most people wouldn't even imagine.
Here's your takeaway. Billionaire exits are never just a sale. They're designed events.
They exit through liquidity windows, not price targets. They use tax-optimized structures, trusts, offshore entities, QSBS exemptions. They manage narrative through media, talent, and story arc. And they preserve control through equity stakes, board seats, or IP licensing.
This is the final play. But for the 1%, it's not an ending. It's just how one system evolves into another.
Coming up next, the final word and the call to action that could change how you operate from this moment forward.
Subscribe to Finance Frontier AI on Spotify or Apple Podcasts. Follow us on X for elite mental models, asymmetric bets, and billionaire strategies that scale. We cover wealth, focus, and strategic growth across all 4 series. Explore them all at financefrontierai.com. Got a founder story or mental model worth sharing? Head to the pitch page and submit it. We may feature it in a future episode.
Sign up for the 10 Times Edge. It's our weekly newsletter filled with AI tools, contrarian moves, and top 1% systems. Only at financefrontierai.com. This podcast is for educational purposes only, not financial advice. Always do your own research and consult professionals before applying any strategy.
Copyright 2025 Finance Frontier AI. All rights reserved. Reproduction or redistribution of this content without written permission is strictly prohibited.
Music in this episode, including our intro and outro track, Dreaming On, instrumental by Nefx, is licensed under the YouTube Audio Library license.